We heard something in the news that Donald Trump has proposed a new tax reform. Therefore, before I start my presentation today, I want to talk to you a little bit about that tax reform. What are the pros and cons when it comes to real property investments? I will say one thing though. I don't see too many cons. All I see is pros mostly. And Trump keeps the mortgage interest deduction. That is maintained. That is not eliminated. So that is super good news for all of us real property investors. Why is that super good news? It's because so many things will be eliminated as deductions. Now, so far, the only thing I heard and I've seen will be that the mortgage interest deduction will be preserved, and deduction for charitable contribution will be preserved. So what does that mean? Are we able to keep our property tax as a deduction? I think that it's quite possible that might be eliminated for your own home anyway. And also, they talked about the state income tax and the local income tax that we pay. Under the existing law, they are all deductible for us as California residents. But under the new tax reform, if that one is passed, we will not be able to deduct state income tax that we pay to the state of California and any local income tax that we pay to our local government. Now, if you own a rental property, chances are you may still be able to deduct the property taxes that you pay versus a home that you own and live in, which is your principal residence, where the ownership has nothing to do with any business purpose. I would imagine that the property tax that you pay for those in the future are likely to be eliminated as a deduction item. Let's see what else he's eliminating, which is good news for us investors, which is the estate tax. He's thinking about eliminating the estate tax. Why is it important? It's because when you die, you don't have to pay taxes on your estate. And that's a huge chunk of money if you are super wealthy. Under the current law, each one of us, as long as you are a U.S. citizen or a permanent resident, each one of us has $5.45 million as state tax exclusion. So if you don't have too much wealth, husband and wife, is close to 10.9 combined for estate tax exclusion. But there are clients of mine who are super wealthy. A couple of weeks ago, one client called me and said, Kenny, I have this problem here. I attended your 1031 exchange seminar, and I'm very excited that I can actually save a lot on my tax dollars based on what you're telling me. And what I told her was that you can do unlimited times of 1031 exchanges, unlimited, all right? So basically, you can defer paying any capital gain tax all the way through until you die. So her concern is that, well, when I die, don't I have to pay all my capital gain tax all at once? Well, I told her the good news is, husband and wife, you got $10.9 million exclusion, which means that unless your estate is greater than 10.9, and if you keep doing 1031 exchanges, when you die, you won't ever have to pay any tax on the capital gain, all right? And that's why it's important for us to know and appreciate what Trump is proposing, because he's proposing to get rid of the estate tax. There's something else he's proposing to get rid of. It's called the alternative minimum tax. If you don't know what an alternative minimum tax is, it's because probably you've never paid it before. For those of us who have paid alternative minimum tax, we know what it's all about. There was one time when the super wealthy, they got so many loopholes for deductions such that they are the wealthiest people in the United States and they pay zero or minimal tax. It is for this reason that it's an embarrassing thing in our tax system. Why is the super wealthy don't pay any tax? Because there were so many loopholes, exclusions, deductions that they know how to use, such that they pay zero or very little tax. So therefore, the government decided to pass the alternative minimum tax. It was intended for the super wealthy. But people like me, I have paid alternative minimum tax, and I'm not super wealthy. I'm middle class. So if you have paid alternative minimum tax, you don't like that alternative minimum tax, so you welcome the idea that it will be eliminated under the Trump's tax reform. Okay? Now, there's one more important thing about the Trump tax reform is what we call the standard deduction. Now, what does the standard deduction entail? For most of us who heavily invest in real estate, we got so much money that we can deduct based on the mortgage interest that we don't ever use the standard deduction, because the current standard deduction is only $12,600 for husband and wife, and for singles it's only $6,300. Now, because currently we still have property taxes that we can deduct. If you bought a home for $1 million, you know, your property tax might be around $11,000, $12,000 in a year, you know, which by the time you add your mortgage interest, you add the local tax, whatever you pay, it's going to exceed the $12,600 for couple, and for single, $6,300 will be exceeded. That's why many of us who invest in properties, who buy multiple properties, we don't ever use the standard deduction. It's because we're better off not using the standard deduction. Now, what Trump proposes to do is, he proposes to nearly double the standard deduction. Now, if he doubles the standard deduction for a couple, it will now be $24,000 and not $12,600. But for an average W-2 earner who doesn't invest a lot, who probably just own a home, they might get a chance to still use the standard deduction now that it's double. But for most of us who own more than one property, the mortgage interest that we pay continue to be deductible. The mortgage interest that we pay for all the properties that we own, it doesn't matter if it's your principal residence. It could be your second home, or it could be a rental property that you own. But if you get a mortgage and you pay interest, all of those interests are deductible currently. So by the time you add up all the interest you pay, if you are heavily mortgaged, husband and wife, for husband and wife, it will easily exceed the $24,000 standard deduction, even after Trump had doubled it. So most of us will still not use the standard deduction. It might affect the W-2 people, you know, an average income earner, such that it makes more sense. It helps them if they use the standard deduction. For most of us, it doesn't. But also, Trump is eliminating so many deductions now. For most people, it actually makes sense to use the standard deduction now, more so than before. Okay, so what else is he changing in the rule? One good thing, though, there will be no change to 1031 exchange law. I don't think Trump wants to touch that. I think he has his own properties to worry about. He has his own past 1031 exchange to worry about. So he's not going to change. Plus, I think it's he's pro-real estate investment, so I think he might not do anything to the 1031 exchange law. And we're going to talk about 1031 exchange today and how it works. We'll go through the mechanics. Okay. If Trump lowers the this corporate tax rate to 15%, it might change your mind about whether you should form a company to conduct your investment business, because you're taxed at 15%. And also, there are some of us who think that you know, doing an S corp is better than a C corp. What happens when you have an S corp, S corporation? The corporate profit actually flows to you individually, and you have to pay the income that you receive to the flow through or pass through according to your bracket. We don't know, you might be in a higher bracket. So this Trump is actually encouraging people to form businesses. He's going to get rid of Obamacare tax. Obamacare tax, the 3.8, will be gone. I never had to pay because I wasn't in the tax bracket yet. But if you're in the tax bracket, you might have paid 3.8% for the Obama health care, which will be removed under the Donald Trump tax reform. So we're not going to even